So the purpose of this is to primarily give the people who are reporting from a profit and loss a different way of looking at figures. And for those that already use gross profit, it's more of a refresher in exactly how you should be using it. So at the end of today, at the end of this, I'd like you all to go away with an idea of how to set a gross profit target and the benefit of doing so. So what are the benefits of reporting from gross profit? Gross profit is available immediately on most management systems. So it's a figure that you could get at the end of any given day. It's actually normally available through the day as well. It's much easier to understand, and I'll go into a lot more detail on why it's easier to understand later in this presentation. And it's actually much more accurate on a daily, weekly, and monthly basis than a profit and loss is. And again, I'll explain in a bit more detail why. So we're just going to run through, and I know I'm not trying to teach anyone how to suck eggs here, but I just want to make sure that we're all on the same page of what we consider gross profit to be, because there are slight variations in what people consider to be gross profit. But for this presentation, this is the formula which we use to calculate gross profit. So you can see these are three separate jobs. Let me just get my mouse up. Can you see my mouse on the screen?
Yeah.
So we've got job 1, job 2, and job 3. So in job 1, we have labor sales of 500, part sales of 400, so total revenue of 900, and the costs of goods sold on this job were 300. So the gross profit for this job was £600. In example 2, it's labor only. So we have labor sales of £80. There are no costs of goods sold, so the gross profit is £80. In the third job is a warranty job. There is no revenue involved in this. It's just pure cost. So the cost of goods sold is £450. Therefore, the gross profit is minus 450. So to summarize, it's revenue minus the cost of goods sold. That's what gross profit is.
And your gross profit, then, your cost of goods sold, because in my account, it doesn't use your wages. Your overheads for wages aren't included as a cost of goods sold.
And I'm really glad that somebody's asked this question, because there is very good reason for it. So very typically, if you're from a financial background or your accountant, what your accountant would consider as gross profit would be revenue minus any direct costs. And in our game, you can't sell labor without paying for your technician. The problem with considering the cost of labor in the gross profit calculation is you don't get the benefit of immediate data, because you don't know what the cost of labor is until the end of the month or after the end of the month. So there are the two variations in how you calculate gross profit. The reason we do it this way is you'll see all the benefits later in this presentation. But if you consider wages as an overhead, you get much more flexibility in the way you report on gross profit. So you're absolutely right. In this scenario, technician wages are not considered in the gross profit calculation. So if we look at the total of these three jobs.
Alex, what about consumables?
So consumables is something I'll touch on at the end, Craig.
Okay.
So if we add these three jobs together, we can see the total labor sales, total part sales, and the total cost of goods sold, and the GP is actually £230. So I know this is really simple, but it is important that we understand this fundamentally. So what could have been a good day was a really bad day because it was ruined by a warranty job. And warranty jobs as business owners are really easy to kind of just put out of sight, out of mind, but they're incredibly expensive and they really damage GP. And it's only really visible when you actually start focusing on GP. So the term I've used in this slide quite heavily is cost of goods sold. And it's incredibly important that we actually understand what this means. So this next slide is going to demonstrate why a profit and loss in most businesses is fundamentally flawed when it comes to understanding the profit of that particular month.
Sorry, Alex, do you allocate a job sheet to every warranty job you do as well, then within your business?
Absolutely, yeah.
Yeah.
All the parts related to that job sheet get sold on that job sheet. So the job sheet still gets posted because I've got to allocate the costs of the goods that I would have sold on that job. Because if I want to calculate my GP at the end of that day, I have to understand the cost of all of the goods consumed, essentially. So if we focus on COGS then, so what is COGS? COGS is an accounting methodology that most systems most accounting systems, most people here, I'll be surprised if you're actually using COGS. So when you purchase an item from the supplier, and in this case, I'm going to use an extreme example of an engine, you exchange cash for product. So the balance of your business doesn't actually change. You don't gain or lose. All you've done is just swap liquidity for an asset, essentially. So the value of your business remains the same. The problem that the way most people would account for that engine was they would actually put it to purchasers instead of stock. So if you were to look at the position of your company at the moment you buy that engine, you would actually lose the £8,000 revenue it cost for that engine. And let's go to a really extreme example. And in this slide here, you can see that we purchased the engine on the 17th of January and we sold it on the 10th. Now, the method that most people use is apply the engine as a purchase in January, and then they would sell the engine in Feb. So all the costs go into the first month and all the profit goes into the second month. So if you look here, January, we lost £8,000. February, we made £10,000. How, as a business owner, are you going to interpret that information? And this is what most of your profit and losses will be doing. So if you get a profit and loss from your accountant at at best a month, 4 weeks after month end, or even 2 weeks after month end, you are probably suffering this COGS issue. So the reason being is because most accounting systems just don't have the facility to deal with this. Now, if you think about what COGS is, it's the costs of the goods you sell. So if you were to do this correctly, in the right-hand side of this slide, this is using the COGS method. So I buy the engine in January. It hasn't hit my profit and loss because I've not sold it. It's just gone into my balance sheet as stock. Like I said, I've swapped cash for stock. So January is zero. There's been no trading in January. In February, I sold the engine and I've correctly allocated the cost of that engine to February. So I can see that in Feb that we actually made £2,000 profit. And in January, we weren't yet trading. So this is the difference. And this is why COGS is so important when it comes to reporting on a daily, weekly, or monthly basis. Now, COGS is quite complicated. Did I make that clear enough for everybody? Because it's really important that this bit is understood. Is there any questions, or have you actually? I can't see anybody's face. If you're nodding, I can't see. Is it? Do I need to go into?
The one interesting point there is that there's also a downside to the COGS method, isn't there?
Go on.
Which is, by using COGS, unless we look at profit and loss, we can't see that engine in stock anywhere.
Yeah, so this is where it's important that you maintain stock.
Yeah.
So if you have a ever inflating stock value, then your GP in theory could be inflated. So let's say, for example, you buy 2 tires and then you only sell one to the customer when you should have sold, on your invoice, you only put 1 tire by accident. Well, you're only going to get 1 tire cost assigned to the job sheet and the other one's going to sit in stock.
Yeah.
So it's going to inflate your profit, but your stock balance will also go up. So part of this is understanding stock value. Now, there is a tremendous benefit to actually running a live stock system, because you would not believe, and I've seen this myself over and over again all around the country, of people who are quite adamant that they run accurate stock until they actually get a stock system in place. And then it becomes incredibly apparent how bad their stock management is. So part of using gross profit, you do have to keep a view on what your stock value actually is. So also don't forget that what I'm telling you now isn't a different way of accounting, it's a different way of reporting. You're still going to get your profit and loss. You're still going to see the figures done on a non-COGS basis. It's just that when we are talking about reporting from gross profit, it's important that you understand what COGS is. So I'm not suggesting anybody here changes their accounting methodology. I'm purely trying to point out the flaws in a P&L statement. Okay, so if we move on to look at GP in a broader example. So these are, again, what I'm trying to do here is emphasize the advantage of using a GP target instead of a profit and loss. So we've got 3 months here, January, February, March. In the brackets, the number of working days. I don't know if this is accurate, I just guessed. So January's got 22 working days, Feb's got 20, March has got 22. You can break it down into a bit more detail. So we've not just got total sales now and total cost of goods. We've got a breakdown of the parts. So I can see part sales, tire sales, cost of part sales, cost of tire sales. So I've actually gone into a little bit more detail. And this is, again, getting a bit smarter with reporting. And if you want to understand where your margin's coming from, you can drill down into a bit more detail. But the maths is still the same. So we can see that the gross profit in January was £34,214. The GP target, and I'm going to go further on, we talk about how to set the GP target, but I can see from here, I know what my GP is immediately. I know what my GP target is immediately. So I can see straight away what my estimated net profit would be for that month. And if we look at February, we've got the same again. We've got a load of figures in here, but you'll notice that my GP target is lower in Feb than it is in Jan. And this brings us to another fundamental problem with the P&L. If you work off a GP target, that target can fluctuate based on the number of working days. If you work off a profit and loss, it doesn't care how many working days there are in the month. Your costs are split between the months, which means you may only profit because of the amount of working days. And you could, in fact, have an incredibly good month, except it's really short and it's got 2 bank holidays. And actually, you've outperformed the month before, but you've lost money based on a P&L. And the month before was actually not that good a month, but it had 23 working days, and you're going to profit every single time that happens. So you then start looking at the months of why have I profited here and not profited here? And it's purely, again, because of the fundamental problem with a profit and loss is because it doesn't take into account the number of working days, where when you set a GP target, it absolutely does. And it gives you a much better picture of your performance when your target fluctuates depending on the amount of working days in the month. Again, it's a big advantage to doing it this way over a P&L. Then if we go to March, you can see, again, we've had much better figures. It's got the same amount of working days. The revenue was much higher. Therefore, we had a much nicer profit. So if we move down here, I've just done this. Again, I'm going to touch on these key metrics later in this presentation, but I've done it here for emphasis. So you can see number of jobs, 345, 323, 334. So we did less jobs in March than January, but we profited much more. And it's all down to average invoice value and profit margin. So this is just an exercise. It's just to emphasize the importance of these figures, but I'll go into a bit more detail later. Have we got any questions on this slide? I'm assuming that's a no. Okay, so let's just touch on a profit and loss. I've been here a few times already, but let's just go over the positives and negatives of a P&L. So the positives are, this is actually your official financial statement that you will report to the HMRC. It's incredibly useful for budgeting, and we're going to talk about budgeting shortly, and it's accurate over a longer period of time. So I've already demonstrated the issues with the shorter period, but over a longer period, let's say a quarter or 6 months or a year, a P&L is spot on and there's nothing wrong with it. So let's talk about the negatives. I'll be amazed if anybody here gets their P&L within 2 weeks of the end of the month. I'll be impressed if a majority of you get it within 6 weeks of the end of the month. And that data is already, for me, it's way too late to act on. A P&L at best can be reported on monthly, whereas GP can even be down to hourly if you wanted to. A P&L is fundamentally harder to understand, and I'm going to show you a P&L shortly. A P&L doesn't equal cash, so you can profit on a profit and loss, and you can still fail as a business because you've got no cash. A P&L is possibly inaccurate because of the COGS, because we're not using COGS on most P&Ls. There is normally always an uneven cost distribution, which I'm going to demonstrate in the next slide. So for example, we'll use some extremes. You get your rates bill, it's £10,000 for the year. You put that in January. You go out for your Christmas due in December and spend a couple of £1,000. Well, that entire cost goes in December. So these are uneven cost distributions. And I mentioned in the previous slide, profit fluctuations just purely based on the number of working days in a month. So you can feel like you've had a good month and you can lose money because it's a short month. Do we have any questions?
Is it safe to say that the reason why it's to act to late on the reason why it's to act to late on is because you can't get your P&L in quick enough?
Yeah, if you think about all the
that's because you will be continuing to get last month's invoices up to 2 or 3
precisely.
weeks.
So I mean, most people here would have been for a month-end process. Your statements start arriving in the first week. You start requesting copies in the second. Your copies start arriving on the third. You've then got your wage journals to do and all varying journals to do before a P&L becomes viable. Yeah. The best I've ever seen is within 2 weeks, and I would still question the accuracy of that P&L at that point.
Yeah.
Okay, so let's just take a quick look at a P&L. So this is actually one of our P&Ls. It's split into two because it's so long, but it does emphasize the problem. And I can also, and this is genuine data, I can also see overhead fluctuations, like I mentioned to you. Look at the distribution of light and heat. There's nearly a £3,000 difference from one month to the next. Motor expenses, almost double. Training, almost double. Accountancy is in one and not in the other. Donations in one and not in the other. So again, if I'm looking at a P&L and I'm not really, really careful with the cost distribution, if I'm basing decisions on the performance of my company from a P&L, that P&L better be the most accurate P&L that you've ever seen. Because if you start basing, let's say you're planning to expand or invest and you're doing it off the back of a P&L that looks profitable, there's just so many potential issues with that without spending so much time refining the P&L. Whereas if I go to the right-hand side, which is what I'm trying to demonstrate today, and you'll understand why I don't have this issue on the left once we've figured out how to set our GP target. Well, I know what my GP is. I know my target is accurate based on my costs spread over the entire year. I know it considers the days of the month. So I know that I'm outperforming my target if this is in the green down here. So this is the difference between a P&L and a GP report. Okay, so let's have a look at what a budget is. So to understand what we're essentially doing here is setting a cost budget. A budget actually takes into account both revenue and expenses, but in this case, we're doing it based on expenses. So let's just read this. Budget is a statement of estimated income and expenses based on future plans and objectives. In other words, a budget is a document that management creates to estimate the revenues and expenses for an upcoming period based on their goals for the business. So in Lindley's, at the end of the calendar year, we set the budget out for the following year. So we set revenue goals and cost goals, which gave me an estimated profit for the year. In this demonstration, we're not going to look at the revenue goals. We're only going to do cost goals. So we're actually going to do half of a budget, and we're going to do a budget based on the cost side. So what I'm going to do now, I'm going to open a spreadsheet. I know some of you have already done this, and I apologize, you've got to sit through this again, but this spreadsheet is incredibly powerful for the people who haven't actually done this exercise before. The ones who have been on John's Accelerator course, you may have done something similar to this. It's got the same principles as what John teaches. But what we're going to do, we're just going to very quickly fill this spreadsheet in with, I think there may already be some costs on there, actually. Let me just take a quick look. Yeah, we're just going to run very quickly through this spreadsheet and how to fill it in. All of this presentation and these documents will be available in the Facebook forum after this. So you don't need to ask for it, you'll be able to download it. So the purpose of this spreadsheet is essentially a budget which averages the costs of your business. So the way that you fill this in, this is what I recommend that you do. You get 3 months bank statements, you get last year's accounts, last year's management accounts, and you work through all of the money, all of the outgoings, and you jot them down and you try and figure out on an average, what is the cost of this? So you take the cost of the entire year and you divide it by 12 because you're after the monthly cost and it's net. Whenever you're budgeting, it's always in net. This isn't a cash flow. This is to look at the profitability of the business. So on this spreadsheet, it is really simple. I've done a much longer video on this spreadsheet, so I'm not going to go into super amounts of detail here. I'm just going to do it quite quickly. You put your costs in here. So in the fixed expenses section, you put your costs in, such as your rent, your rates, water, etc. And it gives you your total fixed expenses. The next part is the wage calculator. It's quite clever because it actually calculates the on costs. So your tax as a company owner, you've got to pay your employer's contribution and the pension. So you can actually see that a salary of 35, I actually think this needs updating for the newest budget, which I'll do. So you can see that a £30,000 salary actually costs you in the region of about £34,000. And then what that does, it actually splits these costs down, and it takes them and gives you a monthly total. Moving further down, we have things like software subscriptions and other expenses. And I just want you to take note of some of these expenses. So let's take equipment maintenance. This is a classic example of why a P&L can fluctuate. You've probably all been in the situation where a ramp's broken down, or you've had a one-off horrendous bill. Our brake roller broke on a Class 7 MOT bay. A new roller was £2,000. And for example, if you didn't do a budget and spread the cost of your expected maintenance over all months, the 1 month that cost falls into is going to lose money. And again, it's another reason why a P&L is, in my opinion, flawed. Look at building maintenance, it's the same. You know, if you just look at your last year's accounts, if you spent £2,000 a year on a building and maintenance, then get the monthly cost. These are estimations, by the way, and I always advise that you have a pessimistic view. So you always try and over-egg your expenses. And never underestimate your expenses, because again, it can lead to bad decisions. Hospitality is one that I always go to. Everybody's Christmas do. I guaranteed if I got all of your profit and losses out, your Christmas expenses would all be in December, which just adds to the losses we all make in December. Moving further down, we've got marketing. There's lots of blanks on here, so you can fill this in. I've put a lot of defaults in here for you to just to jog your memory, basically. But this is just an accumulation of all sorts of businesses' expenses that I've experienced over this last couple of years. So then moving on. Now, this is quite untypical, but what I like to include in a GP target are loans. Now, you don't need to do this, but when I set a GP target for a business, I like that target to be cash positive. Now, if I removed this £2,000 here, and you as a business were profiting £2,000 a month, but we didn't consider the loan repayments you need to make, well, it doesn't take a genius to figure out that you're going to be profiting £2,000 a month, but you're not actually going to be making any cash. So although it's not typical on a budget, well, it's not just typical, it's actually not right to put loans on a budget. For this exercise, I like to put loans in because it just keeps you more focused, and it raises your target. And it means that if you do hit that target, you can rest assured that your cash should go positive, providing your debtors don't increase. The final one is all about what you want to take out of the business. So again, this is a really good way of, if you decide that you want to take an extra £1,000 a month, then you can see what you need to take as a business per day in GP to actually achieve that. So if I added £1,000 worth of extras here, you can see the daily target jumps up. What this is also good, and I always like to do this exercise, is for you to sincerely put all of your perks within this box here. Because it's very easy as business owners to get pissed off and stressed out, especially when you don't feel like we're being paid enough or earning enough for all the stress that we go through. This, an advantage of laying out all of your perks on a spreadsheet like this is it just kind of puts into perspective that we actually most of us will actually do quite well out of the business. It's just we only tend to look at the dividends that we take or the salaries that we take. So once these three columns are filled in, you get a daily target, and it's based on 21.166 working days per month, which is the average across the year. It then takes the average and then times it by the number of days in that month, number of work days in that month. And then it gives you your monthly target. So you see the monthly targets change all of the time. And this is because the amount of working days change all of the time. And when you're setting targets, it's important that the targets are achievable. And you could see that a month with 19 days is never going to be a month with 23 days. And you probably, if you look back over your P&Ls, you'll probably see these patterns.
Alex.
Yes.
Obviously, as you know, we've got one of these, and obviously from your help,
yep.
on one of them, on a blue one, we've put what profit we want to make a month. So hypothetically, if we want to make £10,000 a month, so our P&L there is, our profit there is £1,500. If we want to make £10,000, we put the £10,000 in the column, which gives us more of a gross profit. So we know what target we've got to hit. Yes,
so that is an extremely good point. And I'm glad you reminded me because I should have mentioned that. This is a break-even target. And a break-even target should never be your target. John would tell me off if I didn't say that. What Mark's done is he's actually gone, that's great. I want to take this much money, but I actually want the company to make 120 grand a year. So then if I put another £10,000 on here, there's my actual target. So again, you can use this spreadsheet to do exactly that. Thanks for reminding me, Mark. That is actually a really important point. So you can include your desired profit in addition to what you want your drawings to be.
Alex, do you put that in dividends and perks? Yeah, it always goes in there.
It doesn't matter, mate. It can go anywhere. It all works the same. But in dividends and perks, if you're the majority shareholder, any retained profit is essentially yours anyway.
Yeah.
So for me, I would just put, for example, just put profit here, and you could say we want £10,000 a month profit. There's my GP target per day.
Cool. Thanks, Alex. Cheers.
Yeah, thanks for that.
Alex, I know every business is going to be slightly different, and everybody's going to have their own wants and desires. But is there sort of a rule of thumb what's reasonable to expect over here? You break even on. Is it like
what out of a gap? What sort of profit you can expect from a garage?
No, like you've got that at 15 there. If you were to try and say, all right, well, I want it to do 3.5. To me, that might be a bit unreasonable, whereas sort of 2 grand would be a bit more achievable. Is there a rule of thumb in our industry?
Well, it all depends on your capacity. So it comes entirely, your target should very much be in line with your potential.
Right.
So if I take Kettles as an example, it's a monster of a garage, 11 odd technicians. His daily target is probably eye-watering, but his potential is massive. Right. So your costs should be directly related. I mean, for most businesses, your biggest expense should be your wages, and your wages should be directly related to your potential and your capacity. And in the next spreadsheet, the next slide, now we know what the costs are, or the gross profit target, or our expense budget. We're now going to look at the potential based on our capacity. And again, it's within the same spreadsheet. And I know John's done a very similar exercise. So I'm just going to remove that for this exercise. So we can see that our target is £1,500 per day. And we've got two admin staff and 5 technicians in this business. So very, very typical costs. So
that's the cost to open the doors?
Yes, that is the cost to operate, per day.
Okay,
what it costs.
Thank you. So
the next exercise, and this is incredibly important, and this is the favorite thing that I do for other businesses, is this exercise here. So once a company understands their costs, and I'm sure you've all asked the question, what should my labor rate be? And people, there are so many ways to answer that question, but this is one of the ways to answer that question. If you take your company costs, your costs should be directly related to your capacity and the service that you can offer your customers. So if you have a swanky garage with a nice reception, it costs more money. Therefore, you should in theory be able to charge more money for that service. So what this tab on this spreadsheet does, it takes the daily costs, averages them out to a monthly. So you've got your average monthly costs, and then it makes some assumptions. So the assumptions are there's 260 work weekdays, 20 holidays, 8 bank holidays, 2 sick days. So a total of 230 working days per technician. And the hours available per tech are 8 hours per technician. And in this for this particular business, their average monthly parts profit is £7,500, and their labor rate is £50. So if we actually look at what this table is doing, we're saying this technician works 8 hours, their labor rate's £50 an hour, so their daily potential is £400 yearly and then monthly. And what this does on the right-hand side, it then calculates based on the percentage of those hours sold, which everybody here knows as efficiency. So in my experience, and me and John are actually on the same page here, if you don't break even on about 60% efficiency, you potentially have a viability problem in your business. That's just potentially, because I'm tarring everybody with the same brush there, and it's quite a broad statement to make, but it is based on experience. Now you can see here that this business doesn't make profit until it's 70% efficient. And this is at £50 per hour. So this is selling every hour at your maximum labor rate at 70% of your maximum available hours, and then this company will break even. And that to me is quite tricky. So what I would do in this circumstance is, let's say we change the labour rate to £55 an hour. Now you can see that by putting the labour rate up by £55 an hour and keeping the same capacity, you can see it's actually brought the required efficiency down to what I would consider as a much more realistic value, much more realistic target. Now I've seen businesses that look like this, and I've seen businesses that look like this, and everything in between. I've actually seen a business that had to be over 100% efficient to break even. I tell this story because it's a really good story. We're going over those figures, and 1 month in the previous financial year, they profited. And I said, what was different about this month? The only thing that was different was they had an extra technician, and they said he was rubbish. But that was the only month that they profited. Their problem was that their costs were too high for their capacity. Now, in that circumstance, you have to do one of two things. You put your prices up, or you increase your capacity. There are no other solutions to that problem. And all we did in this exercise, we added an extra technician, and it brought their target right back down to something realistic. So even though the technician that they employed was poor, it gave them the capacity they needed to actually make profit. So again, you can only do this when you actually understand what your daily cost is. And it's a really, really powerful exercise. Again, you can experiment, because you could add more capacity, or you could take capacity away. And you can actually see how this impacts what your efficiency target is. So that is how you calculate the viability of a business, basically, using gross profit, using the gross profit target. Any questions on that? No.
That's amazing.
Okay, so now we know what what gross profit is and a gross profit target is. I'm going to touch on 3 metrics that are so simple, and I'm going to demonstrate the profound impact. I've personally experienced this impact, and I can't explain the difference that understanding, in particular this middle one, has on a business. So really simple: number of jobs, average invoice value, and profit margin. So if we take a look at this in action, so we can see here, again, we've got really, really simple, what looks like a P&L, year 1, year 2, year 3. The only thing we change is the profit margin. So from 70 to 72, 75. And you can see we go from not making any money to making nearly £30,000. We've not increased the costs. We're not seeing any more vehicles. We've just increased the margin slightly, which means we're either doing more labor or we're charging more for the parts, as in the margin on the parts has increased. So if we then take a look at average invoice value, year 1, year 2, year 3, 137, 157, and 177. Look at the difference. This is a very, very typical garage. These are very average figures. I'm sure some of you can recognize these sort of yearly revenues and these sort of margins. Now, it's really important that when you increase the average invoice value, that you retain the margin. Otherwise, you end up just charging more, but not actually profiting more. So it's important that margin is consistent. But these are the average number of vehicles a typical garage would see, with the average revenue a typical garage would see. I've increased the average invoice value by £40, and look at the profit difference, 6 figures. This is the sort of figure that we all want to be making out of a single site. Now, something really cool happens when you do both. So if you increase your margin and your invoice value and you don't see any more jobs, so in theory, your costs haven't changed, all you're doing is maximizing more of the creamier work that is in your garage. So if a car is already in your building and it's already on the ramp, you don't have any of the costs of taking the car off the ramp and in and out of the garage or any of that nonsense. It's much creamier, much higher margin work, which results in higher profit margin, higher average invoice values. So we've gone from making no profit to making £150,000 a year. These figures are not unrealistic. I have data from some of my branches that is halfway to this, but all we've done is focus on average invoice value, and it's had a tremendous impact. It's a lot of what we've been working with Lindley's with Auto IQ. And that brings me to the end.